If you're tired of using indicators that give you late signals or false entries, then this video is for you. Today, I'm going to show you two of the most powerful tools every trader should know. Tools that can help you time entries with precision and avoid common trading traps. So before we dive in, make sure to like this video and subscribe to the channel. That way, you won't miss any future strategies that can level up your trading. Let's start with the first tool every trader should understand. A momentum indicator that helps you identify trend direction and potential entry points with precision. It's called the MACD. MACD stands for Moving Average Convergence Divergence, and it's one of the most powerful indicators traders use to spot trends and measure momentum. It's made up of three key parts: the MACD line, the signal line, and the histogram. All of these elements work in relation to the zero line, which acts as the backbone of the MACD, helping traders quickly see when momentum shifts. Let's break down the MACD step by step, starting with the MACD line. This line is created by subtracting the 26-period exponential moving average from the 12-period exponential moving average. If the 12-period exponential moving average is above the 26-period exponential moving average, the MACD line stays above the zero line, and that tells us momentum is bullish. But when the 12-period exponential moving average drops below the 26-period exponential moving average, the MACD line dips under the zero line, signaling bearish momentum. Our strategy is built on three key pillars: trendline breakout, MACD crossover confirmation, top-down analysis. Now check out this setup on the chart. We're in a clean downtrend with lower highs connected by a trend line. Sellers have been in control, steadily pushing the price lower, but suddenly the price breaks above the trend line. That's our first major clue. The breakout hints that sellers are losing steam and buyers may be gaining control. Now, let's bring in the MACD. Take a look, the MACD line crosses above the signal line, giving us a bullish crossover. That's a strong momentum signal, and in this case, it actually occurred before the breakout, acting as early confirmation. So now we've got two powerful signals: a breakout above the trend line, a bullish MACD crossover. But we're not done yet. To boost our confidence even more, let's do a quick top-down analysis. We're trading on the 5-minute chart, so we jump to the 1-hour time frame for a broader view. What do we see? The hourly chart shows that the market was in a downtrend until it tapped into a demand zone and reversed. Now, as price revisits that zone, it gets rejected again, showing that buyers are defending this area. That's a strong sign of potential upward movement. With higher time frame support lining up with our entry signals, we've got a strong confluence setup. Here's how we would execute the trade. Entry: after the breakout candle closes on the 5-minute chart. Stop loss: just below the breakout candle. Target: the next resistance level, aiming for at least a 2-to-1 reward to risk ratio. And what happens next? The market hits our target cleanly. This trade worked because we combined price action, momentum, and multi-time frame analysis, stacking the odds in our favor. Let's break down another trade example, this time on the Aussie dollar against the US dollar using the 5-minute chart. Right away, you can spot an upward sloping trend line. This shows that buyers have been steadily driving the price higher. But then, something changes. The market breaks below the trend line. This break is our first red flag, a signal that sellers might be stepping in and a potential downtrend could be forming. Now let's bring in the MACD. Take a close look. The MACD line crosses below the signal line, giving us a bearish crossover. This is key confirmation that momentum has shifted in favor of the sellers. At this stage, we've got two major confluences pointing toward a sell setup: a downside breakout of the trend line, a bearish MACD crossover. But as always, we want to validate this with top-down analysis. Switching to the 1-hour time frame, we can see the bigger picture. The market had been climbing, but it recently hit a supply zone, an area where sellers were previously active and got rejected hard. That rejection adds weight to our bearish bias. It suggests that the market may now be on its way down toward the next major support level. So here's how we'd approach this trade. Entry: at the close of the breakout candle on the 5-minute chart. Stop loss: just above the broken trend line, in case the breakout fails. Target: the next key support level, with a minimum 2-to-1 reward to risk ratio. This example shows how trend lines and MACD can work together, but the real power comes from combining them with multi-time frame analysis. Now that we've covered the MACD, let's dive into another powerful tool used by professional traders: the Fibonacci retracement tool. This tool helps you identify potential pullback levels where the price might reverse before continuing in the direction of the trend. It's based on a sequence of numbers known as the Fibonacci sequence, and from this we get key retracement levels commonly used in trading: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. But in this video, we'll focus on the two most important levels: 50%, which represents a healthy retracement during strong trends; 61.8%, known as the golden ratio, a level where price often reacts with precision. These levels are incredibly useful when waiting for a pullback after a strong move, giving you potential entry points that align with smart money behavior. Up next, I'll show you exactly how to draw these levels and how to use them in real trading conditions. Let's break down a chart example so you can see how Fibonacci retracement works in real time. In this case, the market is clearly in an uptrend, shown by a strong bullish move. That's your impulse leg. After the push, we get a pullback. To apply the Fibonacci tool, you start by drawing from the low of the move up to the high. As price starts to retrace, keep your eye on the zone between the 50% and 61.8% levels. This area is often referred to as the golden zone. Why is it important? Because this is where the market often finds support before continuing its move higher. It's a sweet spot where many institutional traders look to rejoin the trend. Now, for traders looking to be more aggressive, you could consider placing a limit order directly inside this golden zone, without waiting for extra confirmation. But here's the trade-off. While this method can offer high reward, it also carries higher risk, since you're entering before seeing clear signs of a reversal. Now let's look at a bearish setup using the Fibonacci retracement tool. In this chart, the market is clearly trending downward, with a strong impulsive move to the downside, followed by a pullback. To apply the Fibonacci tool in this scenario, you'll draw it from the start of the move down to the lowest point of that impulse. As the market pulls back, focus on the zone between the 50% and 61.8% retracement levels. This is what traders often call the golden zone. This area tends to act as a strong resistance zone, where price often stalls and resumes the downward trend. If you're going for a more aggressive entry, you could place a sell limit order inside the golden zone, aiming to catch the next wave down before confirmation. Just keep in mind, this strategy offers higher reward, but it also comes with increased risk, since there's no guarantee the retracement will stop there. Now, while entering trades within the 50% to 61.8% Fibonacci zone can be effective, I don't recommend using this strategy in isolation, and here's why. Let's walk through this example. The market is in an uptrend with a strong bullish impulse followed by a pullback. We apply the Fibonacci retracement from the low of the move to its high and set our entry inside the golden zone, between the 50% and 61.8% levels. But here's the catch. Instead of bouncing and continuing upward, the market breaks straight through the zone, keeps falling, and eventually hits our stop loss. The result? A losing trade. This is exactly why relying on Fibonacci levels alone, without additional confirmation like MACD, structure shifts, or candlestick patterns, can lead to false entries. So how do you increase the odds that the 50% or 61.8% Fibonacci retracement will actually hold? That's where a technique I personally use comes in. I call it the TLL method. It's simple, effective, and when applied correctly, it can dramatically improve your entry accuracy in trending markets. Let's break down what TLL stands for: trend, level, and liquidity sweep signal. For a Fibonacci retracement level to hold, you ideally want all three elements to line up. Let me walk you through a chart to show you how it works in real time. Here, the market is in a clear uptrend, strong impulsive moves upward followed by retracements. Now we spot another pullback, so we draw our Fibonacci retracement from the start of the impulse to the high. Look closely, the 50% retracement level lines up perfectly with a previous resistance that has now turned into support. This is key. In traditional technical analysis, old resistance turning into new support is a classic signal. When price revisits this area, it often bounces. So at this point, we already have two solid factors. The trend is bullish, buyers are in control. We've identified a key level of interest. Previous resistance turns support right in the golden zone. Now we look for the final piece, the liquidity sweep signal. And here it is, a pin bar candle that briefly dips below the support level, grabs stop losses, and then closes back above. That's our liquidity sweep, a classic move by smart money to trap retail traders before the real move begins. With all three TLL components in place, this trade setup now has high conviction. Here's how we'd execute it. Entry, at the close of the pin bar. Stop loss, just below the low of the sweep. Target, the next resistance level. And look what happens next. The market respects the level and rallies straight to our target. This kind of setup, backed by trend, level, and liquidity, gives us a strong edge. In fact, when used consistently, the TLL method has shown a win rate above 75% in trending conditions. It's a simple yet powerful framework that helps you filter out weak trades and focus on the ones that matter. Now let's flip the script and apply the TLL method in a downtrend. Here, the market is clearly moving lower, a strong downtrend made up of impulsive drops followed by smaller retracements. At one point, the market breaks above a resistance level, which temporarily acts as support as price pulls back upward. But that move doesn't last. Instead, the market starts forming a deeper retracement, which sets the stage for our setup. First, we draw the Fibonacci retracement from the top of the move down to the lowest point of the downtrend. Notice how the 50% level lines up perfectly with an old support that's now acting as resistance. That alignment is important. It gives us a high probability area for a potential reversal. So let's check off the first two parts of the TLL method. We have a clear downtrend, sellers are in control. We've identified a strong level, a former support now acting as resistance, aligned with our Fibonacci golden zone. Now we look for the final piece, the liquidity sweep. Right here we see a candle with a long upper wick. It briefly breaks above our resistance level, grabs stop losses from early sellers, then closes back below. This is a classic pin bar liquidity trap, a sign that buyers were faked out and sellers are stepping back in. Remember, a liquidity sweep can appear as a pin bar, engulfing bar, doji, or a long-tailed candle. The key is the manipulation followed by rejection. With all three TLL components in place, trend, level, and liquidity, this setup has strong confluence. Here's how we take the trade. Entry, at the close of the pin bar. Stop loss, just above the wick high. Target, the next support level below. And as you can see, the market respects the setup and drops toward our target. This is the power of combining Fibonacci with the TLL method. It filters out low-quality setups and helps you enter trades with confidence and clarity, especially in trending conditions. Now you've seen how these two tools can completely change the way you approach the market. If you got value from this video, make sure to hit the like button, subscribe, and turn on notifications so you don't miss the next strategy breakdown. Thank you for watching and see you in the next video.